Hello, everybody. This is Professor Wei here. This is Finance 359, Quant Finance. So in today's video, I want to give you guys sort of a review on the discount cash flow framework, which is really the starting point of finance valuation. Okay, and I believe this is a very necessary discussion to prepare you to move forward, because all the subsequent lectures will be built up on the this building block. Okay, so where we are right now is still at the beginning of the semester. So basically, just want to warm you guys up. I know most of you guys only took the 303 before. I think it's highly necessary to help you guys revisit this kind of a classic discount cash flow approaches, which is essential for the other financial instruments. Okay. In class next week, I will lead you guys to work on some exercises regarding the linear regressions, which is also a very useful approach in the financial modeling. And after that, we will jump into the main financial vehicles, which include stocks and bonds. And also we will talk about the primary investment decisions, such as capital budgeting. We want to evaluate whether certain projects are feasible or not under the certainty environment and the uncertainty environment. So basically, we want to develop a model to simulate the risk profile of the company's investment decisions they are engaging. Okay, so that's basically the first, big building block of this course. And after that, we will, change our perspective from the cash flow based model to a brand new scenario, which I call it contingent claim valuation approach. Basically, we will be looking at how the derivatives, such as options, work for the valuation of corporations. Okay, this is also a very powerful tool. And after that, we'll switch from Excel to Python, which is, a very fast growing working environment demanded by the industry people. Okay, we will start from Python basics, work on some, basic functions, variables, if statements, some basic loops, and then we will talk about primary data management skills through, those user-defined packages. And we'll talk about basic data visualizations, and then revisit what we delivered before. So basically, we will kind of use Python to solve some of the fundamental problems we work at the beginning of the semester. Okay, so in that sense, I aim to provide you guys some minimum exposure to different working environments. Okay, so that's the big picture of this course. Okay, now, so back to the discussion for today's video. I will primarily focus on the focus my discussion on the topic of discount cash flow framework. I believe most of you learn a bit in your 303 class. I know some of you might take my 352 and 355 corporate finance class and investment classes before. If that's the case, this video might be a bit easier for you guys. But if you feel like you are not very comfortable with this notion, you have to be super careful, and you should watch this video carefully. Okay, and after this video, I will post another video which contains a series of examples of discount cash flows in the Excel environment. Basically, I will disentangle the cash flow patterns so that you can see clearly how the DCF framework works for the the valuation. Okay. Now let's get started. Oh, by the way, one short note is that again, this document is prepared for the purpose of a review of the DCF framework. Okay, and I will introduce some Excel features in the next video. Okay, and I will answer your questions in class next week regarding the examples, Excel, and whatever questions you have for the DCF framework. Now, before I jump into the technicals, I want to be clear on what is an asset, the definition of the asset. I need to go over this simple definition in all my finance classes. Okay, it sounds like a very straightforward question to a finance student, but I guarantee you it's not. Okay, sometimes it can be very confusing. So what is an asset? So pause the video, think a moment. What is an asset? When we are talking about an asset under the financial context, basically it could be business entity, PP&E, property, plant, and equipment, and something intangible like patents, R&D, research development, as well as financial instruments such as stocks, bonds, options. Also, it could be something even more intangible like knowledge, firm reputation, goodwill, growth opportunities. So it seems like it might be a little bit different from the definition you grab from your accounting textbook. Okay? All these items listed on the screen could be an asset. Okay, so I don't want to read through the definition for you. So think about this. What is the common thread of all these items? Okay, so we are finance students. We need to be able to figure out the value of the asset. But before doing that, we have to identify what is an asset. Okay, so what is the common thread? One commonality is that all of these assets, all of these items can be decomposed into a sequence of future expected cash flows. Okay. Now, I'm not wasting your time. It's really an important concept. In finance, when we talk about an asset, it's nothing more than a sequence of future expected cash flows. So notice my word, it's something in the future. We don't care about the cash flows in the past. We don't care about the cash flow right now. It's really something expected. So economics and finance people, we talk about expectation. Okay, it's something in the future. And it's something that is associated with certain level of the uncertainty. And we call that uncertainty risk. Okay, so at the end of the day, the quant finance is about to measure the level of future expected cash flows, incorporating the future risk. Okay, so given the asset being a sequence of future expected cash flow, then the valuation of the asset is nothing more than a valuation of a sequence of future cash flows. Okay, so notice my word, I'm using a sequence of cash flow. It's not a summation, it's not a product, it's a list of numbers. Okay, there's a sequence. You cannot move the money through the timeline. That's the essential idea the entire Finance 303 is trying to deliver. Okay, you cannot sum up those dollar amount across the timeline. So the value of the asset, no matter how complex it is, it's nothing more than a function of future expected cash flows. Okay, so it's a function. We want to figure out this operator capital V over here. At this level of generality, it doesn't help us a lot. Well, it's not accurate though. Trust me, it does help us a lot in a sense that it gives us a roadmap in terms of how we move forward regarding the valuation. For the primary financial instruments, such as equity-like securities and the fixed income securities, they are all discount cash flow based approaches. Okay, so essentially you want to draw related cash flows and then discount everything back to the present with an appropriate discount rate. We call it cost of capital, required rate of return, required rate of return demanded by the outside shareholders and by the market, okay? And also we use that kind of a framework to address firms' investment decisions such as capital budgeting, feasibility analysis. I mean, this kind of a framework on the screen can be generalized to many sub-finance disciplines, okay? Because no matter what kind of asset, what kind of projects you are looking at, it's nothing more than a sequence of future expected cash flows. That's it. That's simple. It's also very challenging because whenever we are dealing with something in the future, it's going to be super hard for us to figure out the level of the cash flows. And it's also very hard for us to gauge the volatility of future cash flows. And also we might incur some measurement error, and we have also, we also have to deal with a discount rate. Okay, so there are multiple sources of uncertainty. And how to answer that question? Well, this course, along with many other courses, will jointly answer this question. Okay, that's really the main idea of the whole discipline of finance. We want to address the challenge at the intersection of time and risk. And that is one beauty of finance, and that's one beauty of the quant finance. We want to, quantitatively measure the degree of the risk under the dimension of, certainty and uncertainty. Okay, so the starting point is very simple. It sounds quite familiar. Thus, the basic present-future value relationship. Okay, so let's look at this, timeline. You have certain projects. Okay, so basically, you can move the money across the timeline, account for the compounding or the discounting effects. Okay, if you are moving the money from the present to the future, then you are basically implementing the compounding procedure. Okay, if you move the money from the future to the present, so essentially you are discounting back future cash flows to the present. Okay, so basically it's a two-directional process. It depends upon your computation needs. Okay, from present value to future value, that's compounding. From future value to present value, that's discounting. Okay, and there is an underlying assumption, and that is the interest on interest. reinvestment assumption. So basically, the interest that you accumulated from current period are assumed to be reinvested toward future investment and growth. Okay, let's assume you have $100 and the interest rate is 10% over 1 year. Over one cycle, the interest you earn from the first period is 10% times $100. That gives you $10, right? And assuming the interest rate is staying constant, and you're going to reinvest that $10 in your future investment. So $10 times 10% will be $1. That $1 is something called interest on interest. Okay, so in this course, we will hold that assumption in future analysis. Okay, this is extremely important for the financial instruments valuation, okay, like bonds. Okay, all right. So again, this is the basic present value equation. Present value equals to the future value scaled by 1 plus the discount rate to the power of the time frame. Okay, now given one of the given 3 of the 4 variables, definitely you can solve for the last one. Okay, the beauty of Excel is that it can easily take care of this kind of computation, but it's not power enough. That's why in the second half of the semester we want to use Python to work on some more advanced computation. So basically, we want to develop some user-defined function to implement the computation in a more efficient manner. Okay, but the bottom line is we want to familiar ourselves with this basic equation. Present value times 1 plus the interest rate to the power of the time frame gives you the future value the other way around. The future value discounted at the level of R gives you the present value over the time frame of T. Okay, that's essentially the formula capturing the timeline over here. Okay, there is another form of a more advanced cash flow pattern, which we call it annuity. Okay, in the last slide, basically we are just talking about one single cash flow scenario. Now, in the real world, it's going to be more common to see the annuity. So basically, it's nothing more than a series of equal payments occurring at regular intervals. Okay. For example, your utility bills. Every month you have to pay your utility, and also you have to pay for your cell phone bills, and you have to pay for your tuition. And these are all annuities. It depends upon the pattern. If the first payment occurs at the end of the first period, that's something we call ordinary annuity. If the first payment occurs at the beginning of the period, we call it annuity due. Now, you tell me which one is associated with a higher present value. Okay. So obviously, there is one period lead-lag relationship because annuity due, the first cash flow occur at the beginning of the period. So it got one more chance to accumulate the value by one more period. So it's going to be greater than the level of the ordinary annuity. There's one period lead lag. Okay. So there are some number crunching examples over here. Suppose we are examining an asset that promised to pay $500 at the end of each year over the next 3 years. We call this thing to be a 3-year $500 annuity, ordinary annuity. If the discount rate is 10%, what's going to be the value? Now, obviously, you can use the simple present future value relationship to establish the present value. Basically, you discount back everything from the future to the present. That gives you the correct number. But what if the horizon of the cash flow is like 20 years? It's going to be quite labor intensive for you to do that, right? So we want to use Excel, or at least we want to use some mathematical formula to help us to do the job. Okay, on the screen, there is a formula over here, but you don't need to memorize that because Excel can take care of this kind of a computation easily. You do need to be able to visualize the cash flow pattern and identify the cash flow pattern. So basically, you want to know which one is which and what's going to be the correct formula you are going to use. Okay, so this is very important. You don't need to be responsible for the formula itself. I don't think it's very meaningful, but you do you are obligated to be able to identify the cash flow pattern. You need to be able to tell, okay, this is the ordinary annuity. I'm going to use the annuity formula. This is definitely different from the single cash flow scenario. So that's my expectation on you. Okay. A variation of annuity or a subtype of annuity is what we call the perpetuity. Okay, so basically it's a kind of a cash flow that lasts forever. Okay, so it guarantees you a fixed level of payment for infinite periods. Okay, you may think, how come this thing could be deterministic? Well, interestingly, it is deterministic. Okay, and actually, there are some very live examples in the real world. For example, the entertainment giant Disney, which is a very famous entertainment company. They have the well-known Sleeping Beauty bond. So basically, they guarantee the holders fixed payment over the next 100 years, something like that. This is very similar to the spirit of perpetuity. Okay, the idea is to signal the well-being of the financial well-being of the company. Okay, so based on the mathematical derivation, the present value of the perpetuity is nothing more than the ratio of two things: the level of the cash flow scaled by the level of the discount rate. Okay, that's what we call the perpetuity. Okay, there are some other forms of perpetuity, like growing perpetuity. So basically, the level of the cash flow is growing over time and it lasts forever. This is what we call the growing perpetuity. Notice that on the screen, I have this dot, which denotes the fact that this is a form of perpetuity. Okay. And actually, in finance, we call it Gordon dividend growth model. Okay. So basically, we assume that in a healthy financial environment, if the company is dividend paying firm, basically, we assume that the company will pay a constant growing dividend toward the future, and it should last forever. Okay, so if that's the case, all we need to do is to discount back all the future growing dividend to the present. Okay, and that's captured by this formula. Okay, the denominator is quite similar with the perpetuity formula, with the exception that it's the difference of a required rate of return demanded by the shareholders and the growth rate. Okay, you can think of the growth rate is absorbed by the required rate of return, so that the cash flow is discounted at a smaller degree. So it incurs a higher level of the present value. Okay. Now, one implicit assumption is the fact that the growth rate has to be smaller than the required rate of return. Otherwise, the model will be broke down. Okay, because it will incur a negative value if the growth rate exceeds the level of the required rate of return. Okay. Now, one more form of cash flow pattern is what we call the growing annuity. So the primary difference between growing annuity and the growing perpetuity is self-explanatory, right? Just telling from the names, growing annuity, it is something finite, okay? So it is subject to n periods, all right? So we need to use the annuity formula to do the job for us, okay? Now, basically, again, you are not required to memorize the formula, but everything is captured by this formula, okay? In the future, I'll show you how to work on this kind of a computation in Excel and Python stage by stage to establish the value. And this model is kind of very useful in conjunction with a multi-stage framework. So basically, we assume that in general, firms may grow at different stages given their financial needs. For example, startup firms, because they plow back everything they generated internally, they save all the cash flows for future investment ideas, say for future growth. So basically, those kind of startup firms grows pretty fast at early stage. Okay, so the growth rate is pretty high, and after a couple of years, because of the market competition, market power, everything will drive down the potential growth of the firm. So on the second stage, third stage, the growth rate will be lower, so that you can disentangle the entire cash flows of what firm into multiple stages, so that you can use the growing annuity formula to establish the value of the company. Okay, we'll be working on that in the future. So the idea is we have this two-dimensional space based on whether the firm's cash flows are constant or non-constant, whether the cash flows are annuity or perpetuity, so that we have constant perpetuity, constant annuity, growing perpetuity, and growing perpetuity. Okay, so these are extremely important. It can definitely help us to navigate through the cash flow world of basic financial instruments. Okay, in the subsequent set of slides, I have some notes on the interest rate conversion. So basically how to, convert the rate from the nominal rate to real rate. And so it's actually very straightforward. The real rate is what we call the EAR, effective annual rate. The nominal rate should be something quoted. Okay, so it's the quoted rate. So 1 plus the EAR is equivalent to 1 plus the adjusted nominal rate to the power of the compounding frequency. Okay, so in Excel, financial calculator, in Python or whatever platforms, they all have interest rate converter. Okay, I don't even remember the exact function name. You just need to Google it, how to convert the nominal rate to real rate in Excel. It's actually something very easy to figure out. Okay, I'll show you this in future examples. Okay. So I do have some number crunching examples on my slides. You are more than welcome to look at. Okay, so in a separate video for the second half of the slides, I will record. I will post a separate video to help you go over some examples regarding the discount cash flow analysis. Okay, so so far everything will be very natural and fundamental. We will work on everything on the Excel, but I have to emphasize the fact that this is something very important, because if you cannot work on everything in Excel, it's going to be very hard for you to move forward onto some advanced, computing platforms. Okay. All right. I'll see you guys in class.